people, this is real life stuff happening. Here,
nosebleed?
Yeah, a little bit. I think I got it though. What just happened? We hit play and my body just starts falling apart.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk.
And we are back with another edition of the Daily Dots. And I am once again joined by the brain trust himself, Mr. Chase Taylor. He was out yesterday enjoying his birthday, but he is back. First Daily Dots we've ever done with you at the ripe old age of
42.
42. There you go. It's a 42-year-old podcast today. It feels more mature.
Definitely.
You know? Yeah, you're not dragging down the average age anymore. So you've joined the Big Adults Club. Thank you very much. I think it's funny. I'm not sure where that age is. I feel like it's 35 or 40, where once you cross over that age, it's like the 38th parallel. Like after that age, nobody cares. We're all on the same team. You know, like it's over the age of 35, over the age of 40. It's one of those. You know, where you're just like, yeah, what's the difference between 48 and 43?
I think in the last year or two is when I like finally started losing count. Where I was like, am I 41? 40, I'm already 42.
Yeah, that happened to me in my early 40s too.
Yeah.
I was walking around for about 6 months saying that I was 43 when I was only 42.
I think I just did that as well.
Yeah. My wife had to correct me. But I mean, look, it was kind of a glad, sad story. You walk around thinking you're 43 and you're like, oh,
I should do that more often.
I just got a year back. Look at that. You can get younger, apparently.
It's like finding $20 in your pocket.
Yeah, 100%. Except that year would be worth a little bit more than $20. All right. So we've got a lot of different things to talk about, especially since you weren't here yesterday. But why don't we start off giving a rundown toward the markets? Not a lot went on, which quite honestly, when you've got a company like Nvidia announcing after hiccups. When you've got Nvidia announcing after the close, not a surprise. So run us through the indexes here.
Yep. S&P closed down 0.56. NASDAQ 100 down 0.44. Small caps down a little over 1%. You had equal weight down 0.85. Mag 7 down 0.64. XUS was down 0.85, which meant the dollar's probably up. We'll get to that. Oil up a little over 1. Gas up. Gold down about 0.3. The rest of the metals down a little bit as well. Yep, dollar up 0.33. So you're back to 99.88. 99.41 is a huge level there, so bouncing pretty well off of that. And then in Ratesville, the 2-year up 1 basis point and the 10-year up about 3 basis points. And vol is currently 1992, up a tiny bit on the day.
So getting to the issue of the day, and I'm not, if anybody else sees me hiccuping on screen here, I'm really trying to, of course, I never have this issue, but if right when you start the cameras, that's when it's going to kick in.
I don't know how I'm going to work this into the title today, but it's happening.
Today is all about Nvidia, right? I mean, that's it. Now, I don't think that I show them up a little bit in after hours, but not enough. I don't see that they've.
Let's see, data center revenue missed estimates 39.1, and the estimate was 39.22. That will likely be frowned upon.
Oh, they're up.
Well, something else went up then.
After hours.
Let's see. We're doing this live, so we know nothing.
Yeah, but remember the other thing that we've got to keep in context when we're looking at after hours quotes. After hours used to be a realm where only the pros played. You know what I mean?
Oh yeah.
And that is just not the case anymore. And what I have found is after hours trading has become increasingly unreliable. It's just not accurate. So if you see them popping, and if people want to know what I'm talking about, it was Tesla being up 11% in after hours after announcing a disaster quarter. Are you seeing some shaky numbers here? Walk us through with what you're seeing.
So I see revenue is expected to be 45 billion plus or minus 2%. Moving forward, their outlook for the second quarter reflects a loss in their H20 revenue of 8 billion. That's from the Chinese restrictions. That's a lot of money. I didn't realize that was going to cost them that much. That's interesting. Let's see. That's all I'm seeing so far, but CNBC just came out with their own. Not that anyone cares about HP, but they're getting smoked after hours on their earnings.
I don't like this setup, man. I mean, we got to read through the rest of this quarterly report, but
so their earnings beat 96 versus 93 estimate, and then revenue beat. So 44.06, and the expectation was 43.31. So despite the data center miss, they still a double beat on the broader measures. I thought maybe the market would care about the data center part, but maybe it's just people had already started moving those goalposts. Who knows?
Yeah, geez, I'm having all kinds of issues here. I even had a little bit of people. This is real life stuff happening here.
Nosebleed?
Yeah, a little bit. I think I got it though. I don't. What just happened? We hit play, and my body just starts falling apart. Well, hiccups, nosebleeds.
Dimitri did call you the human EMP, so
yeah, that's true.
That's true. You just detonated.
Yeah, I mean, I'm just sitting here going, and I mean, in what world are nosebleeds and hiccups tied together?
I don't know, but I got to work this into the title.
And
too.
you know the irony? The irony is, I was going over this with my doctor this morning. I had one of those. I've got an online doctor, which
sounds great. Honestly,
it's phenomenal. It's phenomenal. And we were going over my blood tests. She said that they were remarkably good.
Nice.
Yeah. My triglycerides are low. Testosterone and estrogen levels are great. All hemoglobin was on point. I was actually impressed. And then that day, right, of getting told how healthy I am, I got a health breakdown while I'm trying to doing a podcast. Anyway,
it's these nosebleed valuations, you know.
That's what it is. That's what it is. It's the nosebleed valuations for sure. So are you here? Okay, so it looks like a decent Q, right?
Yeah, and on the data center revenue is up like I think I saw 73% year over year. So it's the same old same. Like they're growing like crazy. They're gonna, their call is gonna be at the top of the hour here in 35 minutes. They're gonna tell you that demand is completely, in the stratosphere. So they're gonna be fine.
Yeah, Jensen's gonna be like, hey, don't worry. There are still plenty of people that want me to autograph their body parts.
And if you think about it, like from the trade perspective, I've made the joke, like the only thing we really have to sell people is like soybeans and LNG. But the reality is we have a lot of chips to sell. Problem is, we don't want to sell them to China or anyone that we think will give them to China. But the flip side of that is they're making their own chips now. They're getting better and better. And before you know it, they're running the whole market instead of us. So that's been a interesting debate in Silicon Valley is like, well, I mean, there is no real winning AI probably at this point. Like both sides are doing great. Like, why don't we just sell as many chips as we can? So if it'd be interesting to see how much they're throttled by DC on their sales moving forward. Some stuff just came out today on the U.S. trying to restrict more chip making software stuff to China.
An angle I haven't thought about is as China gets better at making chips, especially fabbing them, I would think that would decrease the risk of them doing something
right
untoward with Taiwan.
Yeah, and I mean they're getting to where they can build more and more cutting edge stuff. We're getting to the point where we can't, but TSMC in America can, so call it the same thing. So Taiwan becomes more about like the politics of it rather than some existential chip thing.
Yeah.
Which in a way is healthy. Like that was a very terrifying kind of flashpoint at one point from the chip standpoint. Now it's kind of like, well, it's still terrifying, but just from a regular old politics standpoint, geopolitics standpoint.
HP might be interesting here. HP is doing some interesting things behind the scenes. I don't know how much I can't probably talk about a whole lot of it, but just due to our involvement with our private company, the audio company, HP's working on some really interesting angles on things that nobody else is doing. And I haven't looked at their stock in a while, but if they're getting pounded in after hours, I might want to be, you know me, just because it's down 80% doesn't mean we're going to buy it, but it does mean we're going to stop and take a look.
Yeah, I mean, we have that in common.
Yeah.
Like you can often find me in the dumpster looking around for something useful.
I think I've told you before what my wife calls that, right?
No, I don't know.
She dumpster diving. She's like, you're dumpster diving. And I'm like, I absolutely am.
That's where the bargains are, man.
That's where they are.
Like antique shops, you know?
Yeah. You're popping tags is the great Macklemore put it. Well, and here's the other thing too, is you're doing it in a market where nobody really is. And it can be frustrating at times because you're sitting on things, but you know, I keep going back to like our portfolio and looking at some of those positions. And I was having a conversation with a guy on Twitter today, and he was asking me, he's an ex-money manager now, just runs his own money, but he was like saying, you know, what are any good ideas you guys are looking at? And I just said, you know, I keep going back to the same stuff. Because there are so many really solid companies out there that have great long-term track records, beautiful balance sheets, all that stuff going for them that are just trading at ridiculously low prices. So there's plenty of stuff. It's just not what everybody's looking at, talking about, staring at, all that kind of stuff. And, you know, it continues to work really well for us.
Yeah.
And I don't really see an end to that because, you know, there's so many of these companies where value is a horrible timing mechanism. You and I both know that. But there gets a point where you don't know the timing, but things get so cheap on a relative basis where you're just kind of going like, yes, I'll take some of that. You know, if you're going to sell me this company out there that's got a clean balance sheet, growing positively, throwing off profit, and you're going to sell this thing to me at a 20% discount to their NAV? Okay. I mean, doesn't guarantee, but if you bought stuff like that all day long that fit those metrics, your win rate would probably be between 70 to 80%.
Yeah, especially if you can match it up to, you know, some cyclical industry where you have a better feeling about where the cycle's at than everyone else, stuff like that, then where you can kind of put an overlay on just the valuation, or like valuation or, you know, catalyst, or like I say, if it's cyclical and you like where the cycle's at better than the narrative running things at the moment, yeah, then it can be fruitful.
Yeah. Let's, were rates pretty flat today? I didn't get a chance. I wasn't watching rates.
Yes. So that's been a bit of a wild ride since the last time I was on. You had obviously we started to like pressure higher, a lot of that driven by Japan. They had a nasty auction. We had one tough auction. The next thing you knew, you know, they were kind of saying like, oh, hold on, like we'll sell less duration here moving forward. And they went out and asked all the bond buyers out there, like put out a big questionnaire about that stuff, which kind of shows you like they're getting a little shook by the long end and willing to do something about it. So that allowed rates to come flying back down globally on duration. And then they had another like iffy auction, and then rates turned back around again and went higher. So I saw the UK just came out and announced they're going to sell more stuff at the front end. So that trend is starting to spread. I mean, judging by what's gone on with the 30, 40 year, 20 year paper in Japan, they're going to have to probably do the same. So this Janet Yellen, much maligned Janet Yellen strategy, it's kind of starting to go global, and it's obviously we're not backing away from it, and we aren't going to anytime soon. So it's
something that we probably should have talked about when Janet Yellen was getting panned, even by me, by doing this.
Yeah.
Which was, and I don't think it's the right move, but it is the next can kicking type measure, right? It's another measure. Yeah. And you and I have said from the very beginning, and we're not the only ones. I think it's pretty obvious that if you're waiting for the leaders of the world to take these issues, you know, earnestly and make the hard choices, get comfortable waiting, because it ain't going to happen. And if there is wiggle room for another can kick, they're going to be kicking it. And this is the next can kick. The issue that I've got is the policies that they're all embracing right now don't make duration any more attractive at all. If anything, makes it less, right? Like meaning probably not less, but if you continue to run up government budgets, if you continue to expand spending, right? Again, they're not dealing with any. This is starting to worry me a little bit in the bond market because, in my opinion, I'm looking at rates and rates writ large just aren't matching the picture. Like, meaning, I feel like you've got some mismatched things here where I almost feel like central banks are being given credit for the last 15 years and people aren't stepping back and realizing, hey, guys, short of launching QE, they don't really have any options on the long end of this thing.
No, I mean, and this should be more of a treasury problem than a Fed problem. And that's gonna be one of the interesting things is how on what level is the Fed willing to, and other central banks willing to work with their governments to kind of euthanize the bond problem, right? Because it takes a lot of keys away from them. A lot of their policy, like menu gets a lot tighter, a lot smaller. It turns into a one-page menu real fast whenever you have to do whatever you can to keep rates down. Like it's hard to fight inflation while you're doing that, for instance.
Yeah. And the other thing too is, like we've talked about, you are more brittle to higher rates. I mean, you're less brittle than you were 2 years ago because we've got them now. But meaning, if things start getting tight again and you want to start cutting, there's less efficacy in cuts than there have ever been.
Yep. Right.
If inflation pops up and you need rates to go higher, that is more penal than it's ever been. This kind of pushes into the next part of our discussion I want to discuss today, the economy broadly, where I do not see any flashing red lights at the moment. I cannot help but to fight, or I cannot help but to feel there are many things in the market that have been moving together for a long time. There's things that inevitable. There's many of those inevitable things that are starting to feel imminent, right? Like it feels like there's going to be some type of confrontation on the rates and duration side, not just maybe with us, but with many countries around the world over the next 6 to 12 months. It kind of feels like we're running up against some walls that we haven't previously run up against. And the one thing I will say is then you look at risk markets and they're not pricing that in at all. I mean, it's telling you that it's clear sailing, everything's good. That's starting to be a little troublesome to me.
Yeah, and I think we've seen it on some of these days where duration, started to fly higher on rates, like where you saw the equities, down 1% for like what felt like no other reason than the bond market was getting squirrely. So I think it would be the kind of thing where you would have to go from not really pricing it to having to price it kind of all of a sudden, which again is why, there is one good, way to trade this in the ETF market, but I still wish there was a home builder inverse ETF, because what comes there if we kind of lose control here on the long end, it just, man, they're going to be in trouble. So
who do we know that does that? We know guys that simplify. That's kind of not their thing, though.
iShares, obviously like BlackRock or Blackstone. I always get those two mixed up in my head. One of those does a bunch of them. Wisdom Tree has a pretty good suite of ETFs. Like
it's kind of a tough one to understand. Like,
yeah.
You can find an ETF for virtually anything.
I can probably do like a 4.2x Nvidia ETF, but I can't short home builders.
Yeah,
and there's a lot of stuff like that. We talked about we made fun of this with the Apple. The only short ETF for Apple is a 1x. You can do like a 3x for some of these names. You could probably do a 2x Ethereum short or something, but you can't do a 2x ETF against an Apple, or a 1x against home builders.
And that's another structural part of this market that worries me. There's more degeneracy and in this market than I think we've ever seen in any market. I was sitting there watching a video from a guy last night that was talking about how he'd made 7-digit returns using 100x leverage. And the crazy thing is that you're in an environment now where that isn't immediately just seen as insanity.
Right. That's just saying I drank rat poison and I'll live to tell about it.
Yeah. And because I don't think, I know for a fact most people do not know what that means and what that portends, right?
Playing Russian roulette with 5 bullets in the chamber.
Yeah, 100%.
And winning and then gloating about it.
Yeah. And just you're seeing, though, you're seeing so much of that go on. And then you look at the types of stocks that those guys are playing in and they act like it, right? Those stocks are acting like it. The problem is that in this market, where that used to be, you saw over speculation and over leverage and things like that in the past, but it used to be confined to a pretty small corner of the market or some degens doing this. That is the way retail is investing now, whether via the use of options, zero dated options, right? They're levered to the hilt even when they don't know they are, right? I mean, you don't need to have a margin, you don't have to have a bunch of margin debt to be levered, right? And anybody that's ever gotten hit trading futures knows what I'm talking about. But yeah, now on the economic side of it, I was interested to see what you were seeing in data because I will tell you that other than sentiment data that we got out the other day, that was positive, but like you and I said, to me, sentiment's become kind of a one direction bet, right? Market up, market down. That's going to give you your sentiment indicator. Now I haven't backtracked it and back tested it and seen how closely it follows. My assumption is pretty dang tight. But what are we seeing out there on a broader level economically? Because everything I see doesn't look good. Like I said, I don't see necessarily blinking red lights considering what's going on in the tariff world, but everybody's just passing this off on trade situations. I kind of feel like that's drawing a conclusion. They're drawing a conclusion that I'm not prepared to draw. What are we seeing here?
Yeah. So hard data is fine and has been throughout. And, you go back to 2023, hard data was fine. Soft data collapsed. Usually soft data leads hard data. This time it didn't. So we had that same situation again this year where all the trade stuff led to soft data falling off a cliff. Hard data was like, okay, didn't really blink. But now that we've put a good chunk of the tariffs back in the bottle, soft data is starting to recover. Now, so far, soft data has recovered to levels that are still aren't good, right? So you'll have today, the Richmond manufacturing survey comes in at, it went from -15 to -9. Like, that's not good, but it's better. It's improving. And that's kind of the way all the soft data has been. It's getting better, but it's still not great. But the way I look at it,
but now tariffs, we haven't, we're just now starting to feel the impact of tariffs. Nobody's been paying.
That's fair. But at the same time, we reduce the level of them so much that the impact that we are going to feel is not going to be nothing, but it may well not be substantial enough, at least especially on its own, to cause any sort of serious, employment problems or anything like that. To me, my current assessment is recession odds for the next year, like 30%. I mean, I had them at 100 on Liberation Day, 70, 80% whenever that we climbed down from that, but kept the Chinese inflation or tariffs up at like 150%. But once we pulled those down to the 30-ish, the effective tariff rate on all things right now is 13%. That's like basically the highest in 100 years, but dramatically lower than where we came from. I think you can now, is it going to cause inflation? I think you can get through with that 13% without having a recession. But what I don't think you can do is keep that 2.5% to 4.5% real growth picture we've had the last 3-4 years. Like, you're not going to do that with tariffs where they are.
No.
So to me, my base case would be, and I think what currently the data is lining up to show is like lower growth, a weaker labor market than the last few years, both, but very possibly not recessionary. So like, I would not be surprised if 2025 growth ends up being one and a half, something like, you know what I mean? Something like that.
Yeah. It really, it's getting to the point where I'm looking around going, it's hard for me to, I mean, obviously it's consumer spending thus far, but, you've had multiple legs of this market stool kind of kicked out from underneath it. I mean, with housing frozen up, you and I have talked about, housing is just a big positive. When the housing market is functioning properly and it's cruising around normal, you know,
it's really nice wind in the sails of the economy.
It is, just because it spurs a lot of stuff. I am one. I think it is a bit of a head scratcher how GDP has hung in the way it has. I don't have any red blinking lights to point to. Just it's weirding me out. I get the feeling that a lot of people are out over their skis financially, and it kind of feels like the door could slam rather quickly.
So I think, you know, this is something we've laid out a lot in the last 2 years, the crucial importance of asset prices on the real economy. So whenever we were down 20%, like I was sure we'd have a recession as long as that held, right? But now that you're back close enough to, you know, an all-time high, call it flat on the years, about where we are, like that allows the consumer to basically be okay. And home prices are still growing, but now you're kind of flattening out there. The last like few month over month prints, pretty flat. So I would say real estate flat, equities flat after a few years of anything but flat, right? So if you just look at the consumer's balance sheet on the whole, it's good enough to avoid a big problem, or maybe even a small problem. But that's where like anything that goes on in the future just takes on that much more importance. Like if we go diving back down, because let's say rates rip another 50 basis points on something and we're unable to put that fire out, like, and then stocks trip down and you're down 10% again on stocks. Let's say real estate flips negative on prices year over year, like transactions just get worse because they're already kind of bad. At least, I mean,
they're 0809 bad.
At least to like, I'm saying like people getting the value they were trying to get, how long they take to sell, things like that are still historically good. Not like it feels terrible because of what we got used to around COVID, but if that stuff deteriorates meaningfully from here, then I could see a situation where the consumer is not feeling great. And I hate to say this, but when I say the consumer, what I really mean is like rich people and boomers, because they spend all the money. So we see all these delinquency things, and like I still catch myself the way I did in 23 want to be like, oh man, here we go. Like you're about to see like delinquencies on like subprime autos, and like, but then you think about the how the big economy works, and it's just meaningless. Like a bunch of those people could lose their you know, Corollas to the repo guy, and it just isn't going to matter as long as the boomers look at their 401k and they're like, cool, let's go on another vacation or whatever.
Yeah.
But for now, I think the economy is okay. I think the data is going to keep improving. And as I told you yesterday, like we've actually reached the point, and I feel weird saying this, but we've reached the point on earnings expectations, which, you know, after the trade war got better, earnings expectations have actually kept falling. We've reached a point where like you can, the next 3 quarters grow earnings at about 5-ish, a little over 5%. And that would be good enough to beat the current expectations for the rest of the year. And that actually feels like a low bar that we can jump over to me.
It is. It's just, I'll tell you, it's a tough pill to swallow buying a market at 30 times earnings for 5% growth.
But we came into the year with earnings expectations being 12 for the full year. And now they're around 6. Like, so they've been cut in half for the year, which was totally appropriate in that first quarter when we, you know, got the gasoline can out and some matches and started playing with trade policy. But now that we've largely calmed that down to this point, my assumption is, you know, a lot of these companies put out warnings and pulled guidance and all that kind of stuff during like the heat of the trade war. My assumption is a lot of these companies come back, as long as things do stay calm for another month or two, and go, oh, you know what? Like, actually, we're looking better in the second half than we thought. And I think that you get those revisions back up the other way, and the market will have to rally on that. Well, all else being equal, the market would rally on earnings expectations coming back.
You know, I don't know. I don't know how the average family's getting by right now. Just looking,
The average family, maybe not.
I mean, you know, like if you go out and want to get like a new Suburban today, you know, family car. I'm not talking the Escalade. I'm not talking the GMC. You're looking like $110,000
Yeah.
for a Suburban.
Yeah.
It's insane. And, you know, even if you can finance that at $299 or $199, right? Average household income's what, 150? Average wage is like around 70, I want to say 75, something like that. So 2 working parents, average household income, 150, 160. Your new car purchase costs you 2/3 of your annual income. I mean, look, I know nobody, right? I know nobody's like just cashing out 2/3 of their income to buy a car, but those numbers are staggering.
Pretty sure.
Well, some people are. Yeah. Some people are.
Yeah. 66,000 and change is the current average annual salary. So you're about spot on.
I mean, that's
sure where it was at.
That's just wild.
Median household. Well, this is 2 years ago. Was 80 and change. So
you got
probably 90. Something like that. That's median though. The average is obviously way higher. But.
Well, and if you're a median household, you're not buying a brand new. If you've got that level of income, you're not buying a brand new Suburban.
You're going to buy a used Toyota minivan instead or something. But.
Yeah, but I just looking around, going, I don't like. Yeah, I don't know.
I mean, I think it's clear that the middle and the bottom are struggling. Like, and that's where like the legislation that hasn't passed yet gets interesting with some of the benefit cuts that could end up being a bit of a squeeze on the lower end and importantly on the states as we've talked about. And something else, speaking of that something I've noticed is kind of getting talked about more that is interesting is if you kind of look at the 10-year impact of the budgetary ramifications of it, and you add in the tariff income, it's like roughly a flat. It doesn't add to the deficit if you go all 10 years and add in what we think will be, you know, the tariff income, which we have no idea what it'll be because it changes weekly, but it's not a bad point that it could end up being a net flat. I don't think that's the case because of so much of the stuff that we're like, cool, after the next election, we'll do all these hardcore, cuts.
Well, here's the other thing.
Probably not, but
we got to see where we're at. I mean, look, the other part of it is when you're running deficits this high as a percentage of GDP, and I hate to say this, and I'm not betting against America by any stretch of the imagination and never will, but you begin to sit there and kind of look around and go, wonder if it's possible to continue to grow GDP without government spending going up.
Yeah, well, I mean, like we went from, the whole we're going to cut spending thing to now it's just like, oh, it's fine. We'll just grow our way out of it, which has been what politicians have told me my whole life. It's fine. We'll just grow our way out of it. And here we are not ever having done that.
Well, because it's harder, right? Like, but it's just math. And I don't think you don't need to understand that there's not like a mystical part of this that nobody can grab onto, right? The larger the percentage of your total economy that your deficit is, the more impactful it is when that deficit doesn't go up. You know what I mean? Like just bottom line, I mean, the market is just baking in bigger, or the economy is just baking in bigger increases in government spending. And when that spending quits going up, the larger that deficit is a percentage of the overall economy, not impossible, but the harder it will be for that economy to keep growing.
Right.
It's just a scale issue.
It's just like being addicted to painkillers, and you get to the point where you're taking 80 painkillers a day, and that's just kind of the way the economy is. Like you need more of it and more of it and more of it to feed the problem. And then obviously the worse that gets, the worse the effect is whenever you have to give them up.
Yeah. It's crazy times. Anything else? What do you got data coming up the rest of this week?
we have the rest of the week. We have pending home sales. We'll get the Q1 GDP like relook, second set of numbers on that, and then we'll get April's spending, income, and PCE inflation data. Out of all that, I think pending home sales is important. And then, yeah, that's probably the only thing that's particularly important, unless spending or income levels are a good bit different than expected.
Yeah, probably won't be.
Probably not.
All righty, pal.
The big one today was Nvidia earnings, which seems like the market is cool with.
Well, for now, like I said, I think that after our earnings are increasingly unreliable,
pushing almost 5%.
Yeah, up 5%.
But their call starts in 7 minutes. Maybe they have great news or bad news that makes it much worse or better.
Well, and look, it's one of those stocks that, like I was saying about Tesla earlier. Tesla announced an absolute dumpster fire of a quarter, and their stock was up 11% in after hours, and then just got annihilated the next day.
Speaking of them, they announced apparently that they're going to roll out their Austin robo taxis in about two weeks. And this just happened before we started recording, so I haven't had time to really look into it. But one thing I did look into was the Waymo robo taxis don't they have a watch center that keeps an eye on it, but they don't have people standing by ready to take over the vehicle. Tesla's going to have people waiting to take over the vehicle remotely. So to give you a sense of where the technology is for each, they have to have a driver backing it up essentially. But
that's the other thing is you listen to the Tesla, and I'm not cheering against Elon, but you listen to the Tesla bulls, and you're like, guys, you're still talking about something that doesn't exist. They do not have the best tech, and it's not close. They just don't. You can keep saying it all you want. They just don't. And that's not my opinion. That's third-party auditors that have sat there and graded full self-driving systems, and they just don't have it. Not yet.
Right.
Anyway, all right. Well, that does it for us for the day. You got anything else to add?
Nope. Good.
All righty, guys. Well, we'll see you again tomorrow. You are listening to the and don't forget to look us up on social. Know Your Risk podcast on YouTube, on Instagram,
the socialist,
Instaface,
the socialist of medias.
Yes. That's kind of weird. So anyway, but you guys know where to find us, and on video as well. So you've just been listening to us in voice. That's probably the best way to go about it. But if you're a glutton for punishment, you can get us on video as well. On
Studies
YouTube.
show it's better with just our voices.
Yeah, I would think so. We did start off on radio, by the way. So kind of tells you all you need to know. All right, guys, we'll see you tomorrow. Have a wonderful evening. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.